Great. Welcome to the East Bay Regional Park District Board Finance Committee meeting 27th. It's now 12:30 and our meeting will begin. We'll start by doing a roll call. If you'd like to drop the screen down, and Madam Secretary, will you call the roll?
Good afternoon. This is Allie Haynes, Committee Secretary, taking roll. Director and Chair Colin Coffey.
Present.
Director Ellen Corbett.
Here.
Director Dee Rosario.
Here.
And members of Park District staff participating in this meeting include General Manager Robert E. Doyle, Deputy General Manager Dr. Ana M. Alvarez, Assistant General Manager Deborah Ocker, Carol Victor, District Counsel, Deborah Spalding, Assistant Finance Officer, and Michelle Strawson O'Hara, Assistant Finance Officer.
Thank you. Today's Board Finance Committee meeting is held in accordance with Governor Newsom's executive order allowing board members to participate in standing committees remotely. We are providing a live video streaming via YouTube, and members of the public are asked to watch on our YouTube channel. That link is provided on the agenda for this meeting. We've also provided the opportunity for the public to join the meeting or to participate by sending an email or placing a voicemail with the committee secretary. And people can join the meeting to participate through our Zoom address, which is also located on the agenda. Our agenda can be found on our website, ebparks.org. Do any committee members have any questions about the meeting procedures? No. All right, then I will turn it over to Chair Coffey.
All right, thank you, Deborah. So we will move directly to item number 1, which is the COVID-19 estimated fiscal impacts update. Presenting is Deborah Spalding.
Yes. This is Assistant General Manager Ocker, and I'll do an introduction and provide some economic information, and then I will turn it over to Assistant Finance Officer Deborah Spalding to complete the report. So as we reported to the Finance Committee last month, the COVID-19 pandemic has greatly affected the economy throughout the U.S. Local governments, businesses have certainly had a decline in revenues, including sales tax, transient occupancy, hotel tax, gas taxes. The East Bay Economic Development Association recently held their annual meeting with Christopher Thornburg from Beacon Economics providing an economic forecast, which I was able to attend. Some of his statements included the fact that we really do not have enough data yet to forecast the magnitude of this economic recession. He feels that many economists are predicting a long and painful recovery. However, he doesn't equate this situation to the Great Depression or even the Great Recession because the causes of the economic distress are very different than they were at that time. He predicts that this recession will behave more like a natural disaster and that we will be able to bounce back quickly. Some of the questions that he was addressing during this was, how long will this recession last? And he has, been looking at the data from China and other countries. He expects that the economy will recover in Q3, which is July through September. We'll start to see a recovery. When asked how deep is the recession, he feels overall it could be up to a 7% decline in GDP, where the travel and entertainment industries could be hit harder, but he didn't feel that that was dire. He also made statements that the economy was really quite healthy before this happened, and he expects a rapid rebalancing. That unemployment, although it is very, very high, it's seen as a temporary drop, that most people claiming unemployment are stating that it's a temporary furlough. That savings rates of people have increased, There's no housing bubble right now. There's not trouble in the private or commercial debt market that he is noticing. And so although Q2, quarter two of this year, will be the worst in US history, he feels that the economy will show recovery in Q3. So as I listened to Christopher Thornburg, I thought, wow, he's very positive. So it's good to hear that kind of a positive outlook. After he spoke, we got to hear from one of the executives from the Port of Oakland, who did not have the same feelings about the economy. And he shared that the economy has greatly affected the port revenues, the jobs, and that the Oakland airport was only at 5% of normal activity in March through today. And so that certainly has affected the local economy. So we'll go to the next slide. And as we've shared before, California cities have been greatly affected. And so here you can see some survey information from the League of California Cities, and they are showing the drastic loss of revenues that will require them to consider budget cuts. And so the state of California also has released their May revise. I'm sure you've all had a chance to see that. If you want to go to the next slide. And the governor is predicting a $54 billion deficit, quite different than what he had proposed in January. And in his May revise, there's a very large focus on seeking federal aid from the federal government. But there are cuts right now in this proposed revise to the Department of Fish and Wildlife, state parks, general operating budgets throughout the state, including salary cuts of up to 10%, schools, and others. So when we had our legislative committee last week, we had our Sacramento advocate who's been working in this industry for over 30 years, and he used words like dire and bleak. And so the situation at the state level is not good. We are really hoping that the federal government will provide some additional aid to the state, and that will help to reduce some of the cuts that the state has to make. The state budget typically has to be approved by June 15th, and so we're expecting that that would be approved as an interim budget. And then we're expecting that after the federal government does make some additional aid packages, that they would go back and amend the budget in August. So on the federal side, the federal government, we also have an advocate in DC who has talked about how this is the largest aid package that he's ever seen presented, and that the CARES Act did provide a lot of funding to states, but the majority of it went to states and counties. And although the district was eligible for some of that funding, we didn't see any of it. So the HEROES Act is now before the legislature. And so we are really trying to make sure that we get special districts in there as an eligible party. And we don't expect that the HEROES Act will be brought forward until the end of June. Maybe don't expect that to be finalized until August. And they're seeking, $1 to $2 trillion in additional aid for local governments, small businesses, and states. So now with all of that, I will turn it over to Deborah Spalding, and we will give you, some update on what's going on in the district and what you can look forward to as we move through. Deborah.
All right, good afternoon. So at our last meeting, I presented some information about spending to date on COVID-19 response. So this is just a little more information now that we're a little further into it. So to date, we've spent over $500,000 on our response to COVID-19. The majority has been on PPE, so that's personal protective equipment, cleaning supplies, cleaning equipment, hand sanitizer, and that kind of thing. We've also spent almost $150,000 on emergency-related communication, another $58,000 on signage and message board rental at the different parks, and about $225,000 in overtime costs. The majority is in public safety and a little bit in operations, and then spread throughout the rest of the district as well. Now, looking at the rest of 2020, it's really hard at this point to know how things are going to turn out. It's seeming more and more unlikely that we will be able to provide a full summer focus. So a lot of the programming and operational costs would be reduced in that case. So we're going to continue to monitor our spending and update our projections as we know more. We do, of course, know that our revenues are going to be reduced this year. So it really just depends on how expenditures turn out. I wanted to dive a little more deeply into property taxes and what happens this year and what happens next year and how that'll impact the Park District. So some of this is just reminders of things you know, but it's good to just think it through a little more deeply. So property taxes are the Park District's largest revenue source. So what that means is that a small percentage point change in property tax revenue in the assessed value has a really significant impact on the Park District. We've been really fortunate in prior years that we've had these really consistent increases in assessed value that's going back from like 2011, 2012. And they've really kept pace with our personnel cost increases. And that's allowed us to, even as staffing costs increase, benefit costs increase, that we were able to keep up with that. So down at the bottom of this slide, I have a scenario where I'm showing you what our current 2020 property tax revenue budget is. And so again, property taxes are 90% of our general fund revenue. So we have 154.5 million budgeted in 2020. We expect that we may not hit that target depending on whether there are significant delinquencies. And then looking at 2021, our previous projection had been that we would have a 5.1% increase in assessed value, which would result in about 7.8 million increase to that revenue source. Right now, the state of California is saying it's maybe going to be a 2.8% increase rather than 5%. So that would then be 4.3 million. And then I just have a couple other scenarios here, just again to start thinking about it. So if we were to have a 1% decrease, we would actually have less revenue than we did this year. And if you go back as far as 2009, right after the 2008 meltdown of housing, we actually had a 4.3% decrease in our property tax revenue. So that's obviously extreme. We're not expecting that, but just to give you a full range of scenarios, we wanted to show that to you. And so here's just, again, diving a little more deeply into the personnel cost versus revenue growth. So this is showing all of our personnel costs broken down. Salary, medical benefits, our other pension, other post-employment benefits, pension, and then taxes. So if you look at our budget for 2021, we project from that how much we think it's going to cost in future years. And so we know, for example, that we have various COLAs built into the MOUs, or we can use CPI to estimate how much our salary costs are going to increase. We get our medical benefit and OPEB cost escalations from our actuaries, and pension and retirement costs we know from CalPERS, and then there are taxes on top of that. So we can then calculate how much we think our personnel costs are going to go up in future years. And then we add on to that our pipeline cost, which is how much we expect staffing will increase based on new parks that are opening or new trails that are opening and having to operate those. So that total increase that we were expecting for 2021 was about $7.1 million. And lo and behold, that actually is very similar to how much our property tax revenue was expected to increase. So again, just showing you how fortunate we've been that property taxes have been increasing really in step with how much our salary and benefit costs increase. So, we don't yet know what's going to happen to assessed value in 2021, but it will have a long-term impact on our Park District revenue. So this is just playing out 4 different scenarios. The top blue line is what we had previously estimated the trajectory for our property taxes. So we had from Beacon, we get a 5-year projection of how much we think property taxes are going to be changing in future years. So that top blue line is our previous estimate for 2021, 2022, and 2023. Below that, if you look at the 2021, the light blue line, the 2021 dot, that's the state of California estimate of what they think is going to be the increase for next year. And that's about 2.5%, roughly. So if you project, even if you, so starting at a lower level in 2021, if we then go back to the increases that we were expecting before, you can see that we end up in 2023 quite a bit below where we would have been otherwise. And similarly, a 1% decrease in AV and a 4.3% decrease in AV really has a much longer term impact. So that green dash line is showing you that if we had a big decrease in 2021, you know, on the level of what happened in 2009, we wouldn't get back to where we had expected to be until 2023. So this is our 5-year projection from, you know, well, more than 3 months ago, back in January. And this is where we always want things to be, where the blue line is our total revenue and the red line is our total expenditure. So when we're doing our 5-year projection, we want it to look like this, with revenues coming in just a little bit above expenditures. And we are going to take steps to ensure that we are able to maintain this type of projection, no matter what happens. We are going to take the actions necessary to ensure that this is possible. One way we're going to do this is through the mid-year budget process. So our mid-year budget prioritization is that we will prioritize funding for COVID-19 response. We will be setting aside reserves for the COVID-19 economic effects. And then we want to look at replenishing our reserves, taking care of capital projects that have funding shortfalls. And again, looking at things that are long-term liabilities. So our forest management, fire hazard reduction, the infrastructure renovation and replacement fund, that's the MER fund. Looking at our pension liabilities and stabilizing future pension costs. Environmental remediation, repairs to trails, parkland, and facilities. And then mitigations and adaptations in preparation for a changing climate. So these are all long-term liabilities that we're going to be looking at funding at mid-year. And then lastly, just a reminder about our mid-year budget schedule. So for the past few weeks, divisions have been reviewing their budgets and submitting budget requests. And then in May and June, we'll be having meetings with divisions and discussing those requests and prioritizing them and looking at, you know, what should our priorities be. Those will be brought to the GM and to the executive staff for review in June, and then it'll come to the finance committee in June for the finance committee to review. And then lastly, that recommendation comes to the board of directors in July. So this report is informational only. Our next steps are to continue our analysis. And again, that at mid-year, we will be allocating funding to COVID costs. That concludes the presentation. We can take questions at this time.
Before I go to my colleagues on the committee for questions, I see the general manager wants to have a word. You need to unmute, Bob.
Thank you very much. This is a very detailed report. I want to thank the staff. It's not exciting positive news, of course, but I think the district has managed its finances very conservatively, and I want to thank Deborah and Deb for their presentations today. This is my 4th economic recession that since I've been in the district, and it is obviously the most unique one, going from an extremely positive economic outlook for the district to a very negative one very fast. But I think having the experience that we've had in the past, the first thing that we'll be presenting in the mid-year will be a very conservative look at how we defer the deficits that we think are coming. We have both a reduction in revenue, but we also have an increase in costs, as Deb showed with the benefit list. Those are going to go up while the revenues are going to go down. We are in a balanced position this year. I think 21, 22, and as it showed 23, we're going to have to make some very difficult decisions. But I think this board has made very wise decision in establishing the retirement trust fund. Probably you can anticipate that that will be a recommendation from me to be able to defer some of those increases at CalPERS, et cetera. Any health opportunities we have to invest there. I also really want to talk about, we still have these big liabilities out there of our own infrastructure that are coming at us right now. You've seen some of those, such as things like our water aquatic facilities really need a big investment. So there would probably be a recommendation from me and staff to look at some one-time spending to defer some of those future liabilities now rather than wait and have an increased cost later. Some one-time improvements to fix things that need to be fixed before they cost us more or shut down a facility. It is just ironic that parks are seeing the greatest increase in use in history at the same time when budgets are going to be proposed to be slashed for parks and recreation. As you know, the state parks is looking at a $30 million cut to their operating money. We operate 3 state parks. The impact there is not significant as far as we can see, except for they will also be clawing back any grants that aren't really locked down and aren't really in process. You know, we don't have contracts out the door. So we have already talked about that, and we're already expediting those projects so we don't have the grants threatened. We're very good shape on the fuel reduction programs because they're very active. Even so impressed with staff, even during COVID, we've been able to keep all the fuels programs moving. I think that's very, very important and logical. But we are going to have some tough decisions that the board has to make about the pipeline. Obviously, any new projects that we're starting up that will require additional staff in the short term versus long term after some recovery is a very serious issue. Board members love to cut ribbons and love to deliver on our promises to the public, which we have to do. At the same time, staffing costs by adding additional costly projects for staffing is going to be a real challenge. You have right now about 10 projects that are 90% or more complete. We really don't have a choice to not open them. A great example is the Albany Beach and Golden Gate Fields Trail is not officially open, but it's completed. People are already on it. So we have to do something about managing those facilities that are open. But you will see a thrust of recommendations that are going to be really very conservative and frugal in the sense of what are we spending our money on that is a wise decision that maybe reduce our staffing costs. And those are all going to be the things we want to do first. We don't live in a bubble, but we have had very, very good management from the board and the staff on our finances, and wise decisions have been made. But there are going to be impacts in the 2009 impact, the deepness of that recession. Incrementally, what we did is did everything we can to protect jobs and benefits while reducing, not opening new parks, not opening new trails, not starting new projects. We slowed the machine down on delivery. We also did an incremental 5% and then 5% cuts across the board on everybody's budget. So those are kind of the tools we have right now that are the easier decisions, and we can hope and pray and do the best we can for a speedy recovery. That depends on a lot of things outside of our control. But I think we have a fiscally conservative program and wise investments, and you have very good data before you to look at and to show the public how our decisions are being made. Thank you.
Thank you, Bob. Director Corbett, do you have any questions?
Yes, thank you very much, Mr. Chair. I do have a few questions on the previous presentation, and thank you, Deborah, for that enlightening and not all bad news report. The good news obviously is the work that's been done in the past to keep us in a great financial position, which comes in handy at times like this. So thank you. So my questions are all over the place, but they came up as you were giving the report. One of my first questions is with regard to the CARES Act, we were eligible, but why did we not receive any funding? Was it because the money was directed through the counties, or I'm just kind of curious why money didn't come our way?
Yes, Director Corbett, I think the general manager is going to answer that.
Thank you.
So the issue is the money's just starting to flow to the counties, and it went to the counties directly from our standpoint. While we qualify, we will be competing with the counties who will say we have no nickel to spare. And so we are in the process of pursuing that through legislative advocacy. We did as best we could in Washington, but now it's going to come down to local decisions. And so kind of like the situation we've had in East Contra Costa County, where we do not get our operating funding base from taxes, anytime we have pursued that, it's been a major pushback that we don't have enough already locally. We're not going to give anything more to anyone else. And it's a competitive process. So there's nothing that says we can't have the money. We are qualified, and we have sent that $7 million estimate through the process to Washington. But it will be a wrestling match locally as everybody competes from the county pots.
So I am hoping, thank you for that, Bob. I am hoping that one of the reasons that I've been consistently asking about our role as communicators of the health department's messages and our role as providing mental health and avenues for physical health and other things that seem to me to be sort of in the health department's venue is because of my concern that at some point when funding was available, that we'd be able to take advantage of the work that we've done, the role we have played, the fact that we have communicated the message on behalf of our colleagues in the health departments. So I'm hoping that the work that has been done in all the meetings that you have attended, Bob, and others, to work with the health departments hopefully can be parlayed. So sorry, my thing went off for a second, but that can be parlayed into support from the counties. And I'm hoping someone will look, I don't know if the money came to the counties like in one large bucket or whether there were buckets for health messaging or pieces for the public health piece. So if that is the case, we should look with a fine-tooth comb what's there to help make our argument, and that, you know, we have played a substantial role on behalf of our health departments. So that's why I keep bringing it up.
Absolutely correct. And that's been our strategy from day one, is to get us out there to show we were there for the public, and we're handling, again, the only game in town for people, and we have that support. I'm not sure, you know, how much the health departments within the county administrator's budget process have that clout. We're going to have to work with our elected officials for sure on that. We have great relationships with the Board of Supervisors, but again, it's a competitive process. But you're absolutely right. We have been there. We have put ourselves out there and our staff out there for people related to the importance of health at this time. It's certainly going to be a challenge because it's competitive, but you're absolutely right. We have to follow that up. I will have our legislative staff prepare a report for the board, so we know exactly where that is with the county, and where the money's flowing and not flowing, and who got how much when. And we certainly will be on that.
Okay, that'll be good to know. And then I have two more questions. One's regarding property tax, and the other is with regard to staffing. So with regard to property tax, and Deborah, you were talking about, the concern about delinquencies and a shortfall in revenue to the counties from property tax. So if we take a hit as a result of that because of lower property taxes, is it like dollar for dollar? Is whatever the shortfall is then divided co-equally amongst agencies that receive property tax as revenue sources? How does that actually work? Or do we know?
This is Deborah Ocker. I can try to answer that. So the delinquencies in Alameda County, typically you are lacking the revenue when it's actually due, but then after the amounts are collected, sometimes through foreclosure of properties, then you will get that revenue eventually as a prior year revenue source. The delinquencies are spread across the county. The tax collector has a big formula where they do portion it out. So it's not just the delinquencies in one city all goes to them. They do get spread throughout. So in Alameda County, as long as the taxes are eventually paid, then we should see that revenue coming, but we expect that it would come in future years.
Okay.
Delinquencies typically, when other things in the economy are stable, don't affect the assessed valuation. So the chart that Deborah Spalding was showing us, where we have those kind of dramatic dips that don't recover right away, that is when assessed valuation, the value of the properties, go down. And that does affect us long term. Does that answer your question?
And that's, again, dollar per by dollar, or?
Well, the assessed valuation is 1% of the property tax share. So,
so we have a carved out share and it goes down proportionally based on, okay. I got
yes, the formulas for the different tax rate areas are very complex, and whatever has been carved out for the Park District as a layer, and all other jurisdictions get their layers, and it's different in every tax rate area.
Okay, thanks.
And Ellen, it's also a delayed action. So the assessors don't start reducing. And when they start reducing, they can only come back at 2% per year. I believe that's correct. So they can reduce faster, even though that is a lag, but they can only come back slower, and which is a real problem, because it takes a longer recovery on the upswing as it does on the downswing.
Yes, thank you. And then my last question is, obviously there'll have to be a conversation at some point as we determine where our blue and red lines go with regard to things like staff, Bob, which you were just mentioning. And, obviously there's different models. One of the models is, not hiring new people and allowing positions to stay open and those sorts of things versus cutting. And my preference is the first model. But when will we start having such conversations? When will the board be looking at those kinds of issues?
As we develop our 2021 budget, we will certainly be looking forward to see what's coming. However, the 2021 budget will not be as affected as the following one. As the general manager said, there's a delay in the county when they do assessed valuation. There's about a year delay. And then also our projected costs with, especially with PERS costs, there's a delay in that as well, because, PERS had they didn't meet their investment numbers. And so that loss is spread, but it won't hit until a future year. So as we're putting together our 2021 budget, we're certainly looking forward and we're going to not overdo it.
So are you saying we won't have any staff impacts in the 2021 budget?
No, I guess I'm saying we would, even if we don't see a dramatic drop in revenue right away, we will be adjusting our expenditures for the future drops that could happen.
Well,
And
will
I'll just add one thing. We work with Beacon Economics to do a 5-year projection of our property tax revenues. And so we'll be kicking off that contract pretty soon, and we'll get their projections in August. And of course, they don't have a crystal ball, but they will be giving us a 5-year projection. And that long-term projection is going to help us decide what to do in the short term. So even if we know that we won't be impacted until 2022, we might make certain decisions in 2021 to sort of prepare us for that.
So when will we start as a board, start talking, being more specific? When are we going to start looking at that? We're hearing other sister organizations are having discussions with regard to staffing. So I'm just wondering when we will start having those discussions.
Well, Ellen, I would assume that part of that will happen with the mid-year because you'll have a set of recommendations on what to invest in to actually reduce our cost on future costs. We don't want to fall off the cliff. We want to apply a parking brake and start to slow things down.
Right.
I can tell you, you've also got upcoming the financial workshop. That obviously will be a very important discussion there with the full board. And then you'll have the capital projects workshop, which is going to say, okay, what are we going to postpone? What can we now slow down to reduce those costs? Those are kind of big pieces. The smaller pieces are that, again, that investment to protect benefits and to be able to pay those costs we need to pay and protect those. The obvious issue, if you say, we're adding approximately 30 positions per year, that will be the 2021 thing that you will see. Obviously, that will come way down. How far down depends on what the numbers are and what the board's decision is on that. But that will be the first place that actually starting to pull back on new hires. You have both new hire recommendations in your budgets, but you also have replacement, as you mentioned, which is we may put, what I will do very soon as part of probably the mid-year discussion is say, you're going to have an extra review of any replacement positions. Somebody retires, that normally is routine into HR. We do a replacement. I sign off on that. You probably are going to see more scrutiny, without question, more scrutiny on, okay, can we hold that one off? Is that really essential? For example, for me, police and fire and field operations are extremely high priority, obviously.
Yeah. Yes.
And so that's the place where we're going to have to apply more scrutiny. And I may have to come back to the board and say, this was a priority hire, and I can't recommend it now and be able to communicate those reasons why to the board. But those are the tools we have. The toolbox is pretty limited, actually. And we just have to start to apply that brake and hopefully not jam it on fast and everybody falls off the cliff. That's not our goal. And again, we have been through this before.
Thank you. Yes. And they are very serious decisions. And that's why I'm asking when we will have an opportunity to start looking at that. And then this is really not a big question, but I'm just hoping I can get a copy of the slides that we just went through. If they were in the packet, I didn't see them. So I'd love to get a copy of those slides. Thank you very much. Great presentation.
But before I go to Director Rosario, I just want to piggyback on Ellen's question on staffing for a moment, and that is, perhaps this is best for the general manager. Where are we at as of today with staffing levels?
I don't have that figure today, and we'll have to get it from HR. But I know it's available. I just not prepared for that today, but we'll get that to you right away. It's readily available. I just don't have Kip. I don't know if Anna has any information on that.
Just broadly, how close are we to fully staffing operational staff at the parks, for instance?
Yes, Director Coffee, Deputy General Manager Ana Alvarez. We are prioritizing, even in the time of the pandemic, we have prioritized our recruitment plans, and the number one priority is field staff. So I can answer the question pertaining to field positions, which includes operations as well as public safety. And those positions are relatively online. There hasn't really been a big impact. So we're steady. Where we have an opportunity in terms of improvement lies primarily in the professional ranks and the management ranks, and that's mostly a capacity issue with HR. But field is doing really, really well, and Kip and I are reviewing the vacancy report for this last quarter this week. We'll be able to give you more details at your next meeting.
I'm just curious, generally though, people are working who can work at this point.
Yes, that is correct.
Director Rosario? There you go.
Yeah, I'll dovetail onto both Director Coffee and Corbett's questions. Typically at MidYear, most of our savings is from vacancies, and so that vacancy report is valuable. And also, I'd like to see worst case scenario if recreation and swimming are not available for the rest of the year. I'd like to see what the savings on that as well. But I would agree, I definitely try to avoid layoffs as much as possible. And then that was my biggest question. And then the other was just comment on as the staff goes through, as the divisions go through their budget review, having gone through that myself as a supervisor, one of the biggest things that has an impact are utilities, and having been the treasurer last year, I noticed that a lot of our biggest bills are in water. So water conservation is always is one of those things that can be affected easily. And then and I think that was it. Just to comment, good reports. I think we'll, I know in my neighborhood, houses are still selling, and they're moving quite quickly. So I don't know what that says for the economy as a whole, but I think we're going to be better off than projected, but keeping my fingers crossed, of course. Oh, Deborah, can you explain the Alameda County is cutting us off 5% from our tax revenue, and you said Contra Costa is doing a teeter-totter. Can you explain the teeter-totter?
So in Contra Costa County, we're on what's called the teeter plan, which means that they will pay us the amount that we are owed, regardless of whether there are delinquencies. In Alameda County, that's not the case. So we only receive what is paid, you know, what's owed to us based on what's paid. And so Alameda County said that they're expecting 5% delinquency. So they withheld 5% of our last property tax payment in anticipation of people being delinquent. And then they'll do a true up in August. So they'll look at what really came in. We'll have a lot of time to do that accounting, and then we'll get paid the difference. And hopefully it'll come in better than the 5% that they withheld.
Yeah. And when do we get that payment?
In August.
Okay, great. Okay, thank you very much. Very good report. Well, there's more yet to be seen. Thank you very much.
And Dee, if I may, so just what usually happens in a recession is you're still seeing sales, and those are still at the higher level of the increase. What happens is people will start to freeze as it comes down and not make sales. They'll hold off as long as they can. Obviously, you don't want to sell your house when it's going down. You want to sell it when it's going up. And so that's, again, that lag time. So delinquencies is one thing. That's somebody not paying their bill. the assessed valuation is going to be a lot of pressure on the assessors to see what they need to do. And they don't want to, obviously, they don't want to lower the money into the county tax rolls. So there is this lag, and that's kind of the unknown of where things are.
Yeah. Well, I one question regarding Measure CC, Measure FF. I am assuming that we have to keep those commitments are solid as far as staffing.
Those commitments are solid, but we do control the timing. So what the ones that are in there now that are the existing staff, those are solid, and that's going to be really important to protect those for the staffing levels. But there are new projects that also increased additional staffing. Those are decisions we can make to not do those projects yet. We do a project, we have to add the staffing. So there are some, not all, that we can delay without diminishing our commitment to the public. We're going to wait a couple of years or 3 years, but the current projects and current funding that's allocated to staff and CC and FF for projects that are open, we really can't diminish the staffing levels, and we don't want to. We want to be able to maintain what we have.
Good, thank you.
It'll be interesting to see what happens, Bob, with construction contracting coming up. There may be actually more competition among suppliers and labor.
And we're already seeing that. We've already had bids come in much lower than last year already. So that's kind of been a fast. That may have been COVID related directly, not because people want to get their people back to work after sheltering in place. We don't know I really do think that's less the overall economic impact and more the slowdown that happened because of people being restricted on how they work. But we are seeing that already, and that's the double-edged sword. We may have opportunities to complete projects cheaper, but then they require the staffing to maintain. Right. These are the difficult walkthrough that we have to do on balancing these things out. But yes, prices are starting to come down on construction, and prices will come down also on labor for new opportunities to hire people. But that may not be our opportunity, because we need to be really careful on expanding the base budget.
Everything's complicated, isn't it?
Yes.
Yeah. So are we ready to move on to item 2? I understand. I'll come back to Ellen. There is no public comment pending on this item.
No public comments have been received at this time.
All righty, Director Corbett. Unmute. You're still muted. There you go.
I think the host pushed my button. So I couldn't unpush it. I have just a quick question on the list of items that are funded by other sources like state or federal funding that we want to get out the door. Do we have a very specific list of those, priority list, and is that something we can see what our priority list is and what our list of projects to be done with state and federal funding before it disappears? Do we have such a list? Because I'd love to see it if we do.
That's absolutely part of the capital finance that you will be seeing really soon, and that's what staff is working on now. We'll try to highlight those, Deborah, because that's a great question. We can highlight those as part of that review.
Yes.
So, thank you so much, because we want to, of course, use those dollars before they get swept. Yeah, thank you.
Okay, so we'll move on to item 2, which is March 31, 2020 investment report and portfolio review. Deborah Spalding and our investment advisors.
All right, good afternoon. I'm just going to give a quick introduction here, and then I'm going to turn it over to, we have Monique Spike and Allison Coney here from PFM. So in your packet, we have a page that gives you all this detail. And I'm just gonna kind of break it down into different chunks. So first looking at the district's liquid portfolio, and we are comparing our current performance as of March 31st to the previous quarter and to the previous year. So just a couple things to note in our liquid portfolio, mainly that our earnings are continuing to drop. So you can't really see that here, but of the 128 million roughly that we have in the liquid portfolio, it's earning almost half of what it was a year ago. Now looking at our short and mid-term securities. And so these are investments in treasuries and bonds. The main thing to note here is that we've increased our holdings in US treasuries. We've decreased holdings of asset-backed securities and supranationals. And the other thing to note that Monique and Allison may hit on is if you look at that amortized cost basis and the market value, you can see that the market value currently of our short and midterm securities is higher than the amortized cost basis. So that's the value if we were to sell those assets today. And the reason that their market value is higher than the amortized cost basis is because the federal funds rate has been reduced. So anything that we bought previously that was giving us a higher return is now more valuable today. So that market value is higher. That, of course, we're not actually going to sell those securities, but compared to the amortized cost basis, it's just showing how much better those old securities are performing compared to what we could buy today in the market. And then lastly, looking at our project funds. So these are the funds that we have from our Measure WW and Measure AA bonds and from our promissory notes. If you look at how much we have in those project bond funds as of March 31st, that's decreased from the previous year and from the previous quarter as we are spending funds on capital projects. And so I'm now going to turn it over to Monique and Allison from PFM Asset Management. They'll discuss the economic impacts of the COVID-19 pandemic, and they'll review the results of the district's portfolio through March 31st.
Thank you, Deb. We are going to have Allison share her screen so you can follow along with us on the presentation that we prepared. As is typical, we will start by speaking about the market environment that persisted throughout the first calendar quarter of the year. And, try to add some commentary that sort of catches you up where we are today with regard to market conditions. Allison's going to lead us off on the discussion, and then I'll talk more specifically about the impacts on the district's portfolio.
All right, thank you, Monique, and good afternoon, everybody. It's nice to be with you here today, even though remotely. Still hope you're all doing well. As Monique said, I'll just start off with a brief market update. And I will note that the presentation or the report is put together at the beginning of April, and it summarizes the economic activity and portfolio activity for the quarter ended March 31st. But because, time has passed, we will give you an update on what's been happening in the economy and in the portfolio since that time. So the first page here of the report actually takes a look prior to the start of the first calendar quarter. And that was, ending the year 2019, even early 2020. The U.S. economy was quite strong, here showing GDP coming in at around 2%. Consumer confidence was very high, therefore consumer spending was quite high. The housing market was picking up, and the employment sector was very strong, averaging close to 200,000 jobs each month, the unemployment rate down below 4%. One reason I want to point this out, to remind us what things were like, before the coronavirus impacted the United States, but also just to highlight the difference of the period leading up to the last recession, the 08-09, financial crisis, where in the U.S., fundamentals were starting to weaken. The banks were in a pretty tough position. There was the housing bubble. So a very different situation leading into the 08-09 financial crisis and subsequent recession to where we were heading into our current situation. But we are in that current situation. We are in a recessionary period, and that really is a result of the coronavirus. And what we have is a three-pronged crisis, we're calling it. First and foremost, a healthcare crisis, and the pandemic really came upon all of us across the globe very quickly. In the US right now, we have over 1.7 million cases, over, unfortunately, 100,000 deaths at this point. And with no vaccine yet and no effective treatment, countries went to and have gone to extreme measures to try to contain the spread. And so in the US, those measures spilled over very quickly into the impact on the US economy. When states started to issue their shelter-in-place orders, social distancing measures, closure of non-essential businesses, the economic impact, the effects on the economy came very fast. And then the third prong here is the effects on the financial crisis. And really that was financial markets. And really that was kind of a mini crisis. And that's because the Fed stepped in very quickly to prevent a full-on financial crisis. And we'll talk about that a little bit later. But getting back to the impact on the economy, the impact was seen very quickly when jobs data started to come out, unemployment data started to come out. The slide here, the chart on the left shows initial jobless claims through March 31st. So these are people filing for unemployment for the first time. And this chart goes back to 1970. And I think it almost looks like there's a mistake on the chart when you see that line shoot up there on the right-hand side. Just truly unprecedented levels of people filing for unemployment as, again, businesses shut down, people were laid off. And by the end of March, they had 10 million new claims filed. That number, of course, has continued to increase. As of last week, that was over 38 million people have applied for initial jobless claims. Putting the unemployment rate, quite high, actually higher than what the official unemployment rate is showing us. And the chart on the right-hand side, we started to see some of the official jobs data come in. And then again here, this chart is updated just through March 31st, showing a monthly change in non-farm payrolls, again, going back here to 2007, prior to the last crisis. And you can see here showing 700,000 jobs lost in March. The April report has since come out, of course, and that showed that 20.5 million jobs were lost in April, and the unemployment rate went to 14.7%. Recently, Fed Chair Powell said he thought unemployment could get as high as 20 to 25% before really this is all over. The next page looks at overall growth in the economy and looking at GDP forecast. Since the chart was put together, first quarter GDP has come out at minus 4.8%, so really in line with the forecast here. And if you think about it, the coronavirus really didn't start to impact the United States until mid-March. And so most of the quarter had already happened before businesses started to shut down. And so just that small period had a pretty big impact on growth in the economy. As you can expect, the expectations for second quarter growth are quite severe. The blue bars here show the range of forecasts, with the yellow dot being the average. So the average here about a minus 30% GDP for the second quarter. And then forecasters do expect there to be a rebound starting with the third quarter, but there's a lot of variances on how fast the U.S. will rebound and how strongly. And of course, a lot of that will depend on when businesses are able to open back up, when we get a vaccine, when life can go back to normal, if you will. So now we'll get into the impact on the markets. I'm here just looking at stock markets by the S&P 500. Of course, we don't invest the funds that we manage for the district in the stock markets, but it's always helpful to see what was going on there. I'm here showing the S&P from March 2017 through March 2020. You can see stock markets fell very quickly there at the end of February. They fell 34%, the S&P did, from peak to trough. But they have come back. Here showing up 20% from the bottom. Since then, we've moved up 35% from the bottom, but still about 8% below where we started the year. And really the stock market has come back because of Fed action, which again, we'll talk about here in a little bit. So now turning to the bond markets, the markets that really do impact the district's portfolio, the market where we invest the portfolio's funds. The chart on the left here shows the U.S. Treasury yield curve at 2 points in time, at the start of the quarter, December 31st, and then at the end of the quarter, March 31st. And you can see there just a large drop across the entire yield curve showing 3 months out to 10 years. And on the short end, that was really driven by the Fed rate cuts. The Federal Reserve cut their Fed funds target rate by 1.5% at 2 emergency meetings in March, and the current rate is now 0 to 0.25%. And the chart on the right-hand side, you can see the 3-year U.S. Treasury yield over the past 10 years. So just showing you where we are now, about, or even lower than where we were during following the 08-09 crisis, the last time the Fed lowered their target rate to 0 to 0.25%. So interest rates in the bond market fell very fast, very hard following the Fed's rate cut. Now, just point here on the longer end here, the 10-year down at a 0.66% at the end of the quarter. That's actually the first time that the 10-year has been below 1% in history. So really across the entire yield curve, interest rates are way down. And that's about where they are today. Interest rates haven't moved much since the end of the quarter. They've remained pretty steady at these very low levels. On slide 7 here, another impact that the coronavirus had on the bond market, and that was yield spreads widened. So as a reminder, yield spreads we talk about here is the yield difference between U.S. Treasury and other sectors. So on this chart here, we're showing the yield difference between treasuries and agencies, mortgage-backed federal agencies, high-quality corporate notes, and asset-backed securities. And these charts, again, go from 2007 to the end of first quarter 2020. So you can see the yield spreads, you look at the far right-hand side of the chart, yield spreads did spike. And that's, again, when investors, when there's uncertainty, when there's concern, when we're in a crisis, investors want safety. So they leave the stock markets and they move into U.S. Treasuries, but they also leave other sectors of the bond market, even very high quality sectors like federal agencies, like high quality corporate notes, high quality asset-backed securities. Investors really seek U.S. Treasuries during these periods of stress. And when they sell out of the other sectors into treasuries, it pushes treasury yields down, pushes some of these other sectors higher, and your yield spreads widen out. And one of the reasons I'd like to wanted to point this out is it really impacts the performance, the total return performance of these various sectors, and in turn, the district's portfolio. So turning to the next slide, we show that here. So this page here shows sector performance, so not the portfolio's performance. Total return performance, so taking into account realized earnings as well as any unrealized gains or losses. And then we're showing 2 different indices, a shorter 1 to 3 year, a longer 1 to 5 year, and then the different sectors on the bottom. And I'll just talk about the 1 to 3 year chart so as to not cause confusion here. So if you look at the 1 to 3 year chart here in the various sectors, you can see that U.S. Treasuries here were the best performing sector for the quarter. And they had a very, very strong quarter. So the U.S. Treasury 1 to 3 year sector returned 2.8% for the quarter. And that's an unannualized number, so just for the quarter. And really, again, that's because interest rates fell. And when interest rates fall, and especially when they fall as much as they did during the quarter, your market values, your unrealized gains move higher. As Deb pointed out, when you look at the portfolio, and as Monique will talk about a little bit later. So those unrealized gains increased significantly during the quarter, resulting in strong total return for the Treasury sector. Federal agencies also did well. They had a nice positive return for the quarter, but not as well as Treasuries. Again, Treasuries were the top performing, interest rates fell the most. And then as you move into the credit sectors, you can see they did not perform as well. Here showing asset-backed security sector, high quality corporate sector, and then lower rated corporates, just for some perspective. And again, even the high quality corporate sectors, investors sold out of those sectors to buy treasuries. And so they had some unrealized losses in those sectors, resulting in very small negative returns for the quarter. And then the lower quality, as you can guess, had the lowest returns for the quarter. Since quarter end, these relationships have flipped kind of back to normal, if you will. The credit sectors, the high quality credit sectors are again outperforming U.S. Treasuries so far quarter to date. As the markets have calmed down, as the Fed stepped in, there's a lot of confidence in high quality corporates, in other credit sectors. And so those returns are once again outperforming U.S. Treasuries and federal agencies. And finally, in the market update, just to give an overview of what the Fed did. So I mentioned, the Fed stepped in very quickly to prevent the coronavirus, the healthcare crisis, from becoming a financial crisis. For a short time there at the end of February, we did start to see signs of weakness in the financial markets. We saw volatility spike significantly. We saw liquidity kind of start to thin up a little bit. But then the Fed stepped in with a whole slew of programs. They stepped in much quicker than they did in the last, 08-09 crisis. And one reason they were able to do that is because a lot of these programs they had to create back then. And this time they just, kind of had to dust them off. They did expand some, but they had the programs ready to go. And they also learned a lesson from the last time, to step in a lot quicker. One of the first things the Fed did, as we talked about, was they cut the Fed funds target rate by 150 basis points at 2 emergency meetings. They had a meeting scheduled for late March, didn't even wait till then. Instead, they had 2 emergency meetings in early and mid-March and cut that interest rate. And then they rolled out a whole range of programs designed to provide liquidity and keep the markets moving in hopes that, it wouldn't spill over into the broader economy. And so just here listing some of those various programs, programs to support the commercial paper market, to support the asset-backed sector, the municipal sector. For the first time ever, the Fed is able to buy corporate debt, including some lower quality corporate debt, again, just to keep money and keep liquidity in the financial system. They've also revamped their quantitative easing, where they buy outright in the market, treasuries, federal agencies, mortgage-backed agencies. Quantitative easing, they did a lot following the 08-09 crisis, and they have, again, started that up. They really stated that they're going to give unlimited support, as much as the markets need to keep going. They haven't really capped any of their support. Fed Chair Powell has, reiterated that in various public interviews that he's given recently. The Fed is doing all they can to support the financial markets, and they've been successful. As we said, financial markets are very stable. The various sectors are doing well, and that's even though a lot of these programs have hardly been used. Just the fact that they're there has really calmed the financial markets. And then one last thing, which I don't have a slide on, but of course Congress has stepped in to support, the individuals, the small businesses. The Fed's there to support the financial markets. Congress has passed various measures. The biggest one, of course, as you're all well aware of, the $2 trillion CARES Act, which included those one-time checks to individuals, extended jobless benefits, loans to small businesses, as well as to states and municipalities. They passed subsequent program measures, and then they continue to debate further ones. So we may see more going forward. So that concludes the economic update. If there are any questions, we can take them now, or you can wait if you'd like until after Monique presents the portfolio.
Why don't you just keep going on, and we'll hold questions till the end.
Okay, sounds good.
Thank you, Allison. As Allison mentioned, Treasury yields did plummet throughout the quarter, both because, of course, of the zero interest rate policy of the Fed, them cutting rates by 150 basis points in March, as well as along with some of that flight to quality that we saw as investors fled to the safety of the Treasury sector in the midst of the volatility. Impact on performance, which you'll see in a few slides, of course, is that your Treasury benchmark was the best performing asset class. So the performance of the district's portfolio lagged the benchmark, but did provide great absolute performance. I'll talk about that in a moment. In terms of our strategy, one of the things that we really held tight to during the quarter was a re-emphasis on the district's primary objectives for this investment portfolio, which were, of course, preserving the safety of the portfolio, preserving the capital in portfolio, making sure there was enough liquidity in the portfolio to meet operating expenses, and lastly, thinking about the yield. So the primary strategies we did was really looking to maintain the duration of your portfolio, so looking to maintain that maturity structure. One of the interesting things about the quarter that Allison did not mention was the fact that typically at quarter end or month end, you would see the benchmark reset and the maturity structure of the benchmark reallocate. And this quarter, in an unprecedented move, the benchmark did not do that because it did not want to force investors to restructure or reallocate the duration of their portfolios. So that is something that happened. We also restricted all credit and asset-backed security purchases at the end of the third quarter, because with that desire to maintain the safety and liquidity of the portfolio, we did not want to add any new credit risk to the portfolio, and we also did not want to add any securities that were having any liquidity constraints. Our credit stance has relaxed now that we're well into the second quarter, but that is a strategy that we emphasized the first quarter. And we did increase our allocation to U.S. Treasury and federal agency securities. And that, again, was purposefully done. We wanted to make sure that the district had high quality, very liquid securities in the portfolio in the event you did need to access this cash at some point in the future. Moving on to the portfolio allocation and compliance statement, you can see from the securities portfolio, we have 135 million of securities. And when we compare the portfolio to last quarter, you can see that the portfolio increased 5% in Treasury securities. You'll also see a slight increase in corporates, but this really had to do with some of the corporate purchases in the beginning of the quarter. Moving forward. So a couple of things to point out on the portfolio snapshot. I do want to direct your attention to the portfolio statistics on the left. We had mentioned a few times that the portfolio cut rates significantly. And last year, rates were already declining, so we had seen a drop in market yields, but the drastic drop in interest rates in the first quarter do indicate that we should expect rates and earnings to continue to decline in the future. If you look at the yield at market statistic, which is 1.20%, that statistic tells you what you would earn if we had to repurchase this entire portfolio on March 31st. The yield at cost tells you what the district is actually earning. The district is actually earning 2.29%. So even though we'd be looking to reinvest at lower yields, that 2.29% should sustain our earnings for some time. So you will see your earnings decline, but not as fast. A good proxy for that is your maturity structure, where we see about 28% of the portfolio. That includes, of course, the amount of assets you have in CAMP. We'll be looking at reinvesting in the lower rate environment. Moving forward. So this is your total return presentation, and recall that your total return includes both the income you earned on the portfolio as well as the market value change on the portfolio. Now, the district's benchmark is the 1 to 3 year US Treasury index. And as I mentioned already before, that index or treasuries were the highest performing asset class. So everything the district earned, corporates, agencies, et cetera, detracted from performance, but absolute performance for the quarter was extremely strong at 1.60%. And that's just a quarterly return for the first quarter. As Allison mentioned, market dynamics have returned to some normalcy throughout the second quarter. So we're starting to see again the benefit of that diversification, where you're earning your earnings from the corporates and the other diversified securities is compensating from price changes in the first quarter. Moving forward to earnings. So the portfolio on an amortized cost basis earned 1.3 million just for this portion of the portfolio. And you can see the big difference between the amortized cost earnings and the market value earnings, which are 2.3 million. And that has to do with the change in value, as both Allison and Deb pointed to earlier. As interest rates fell dramatically, the value of the district's portfolio rose in value. So we're seeing big market price adjustments for the portfolio, and that contributed to that overall strong absolute return in the portfolio for the quarter. Now, a couple of things in terms of the managing the portfolio in a crisis environment. Much of the first quarter was very much a crisis environment. Even before the Fed took that drastic action in March, we had been seeing trends throughout January and April. As I mentioned, we reinvested all your new money in government securities, that's treasuries and agencies. We had increased the surveillance of all the corporate and asset-backed securities. I had already mentioned that we put corporate purchases on hold, but we did essentially reevaluate all the corporates in our portfolios overall on our approved issuer list to make sure we were comfortable with the exposure, taking a look at both industries that we felt had high exposure to COVID-19, and as well as in the asset-backed securities market, even thinking things about consumer behavior. We expect the market impacts to be prolonged. The current health crisis does continue, even though some of the shelter-in-place orders are being relaxed. It's something that we're keeping our eye on. And as I mentioned already, we are relaxing some of our stances on the corporate market. In terms of liquidity, we're going to continue to be in touch with your staff about any needs from cash flows in the portfolio. We had been doing a number of different things, stress testing, et cetera, looking at the liquidity in the portfolio to make sure that if you do need to access cash, we'd be in a position to raise that cash in short order for the district. Lastly, we really wanted to work on prioritizing communication. I want to reassure you that in addition to making sure we kept in contact with your staff, we had also been hosting a number of market updates and communications about the market volatility for all of our clients to make sure that our clients were informed that if they did receive any questions, they'd be able to answer those about the strategy. And are there any questions? That concludes our formal remarks, Director Kofi.
So I will turn to Director Corbett first and then Director Rosario for questions. You're muted.
I don't have any questions. I do appreciate the sensitivity to, the ups and downs, and also the opportunity to have open lines of communication. But I don't have any questions at this point. I just appreciate that we have good people watching these things on our behalf.
Director Rosario. You're on mute. There you are.
There we go. Thank you. Thank you for the report. Yeah, I just appreciate the amount of scrutiny that you're giving our accounts. I do have one question though. I mean, I've brought this up in the past, but the corporations that are rated triple B, and I know we're there because some other entity considers them double A or something like that. But and I just noticed that the triple Bs were the worst performers. Is that something we should be looking at in the future? Not necessarily now, but whenever the time is right. But possibly moving out of those?
Yeah, no, that's a good question. We have been increasing, as I mentioned, the scrutiny on all the issuers on our portfolio, particularly the lower rated issuers, of course. One of the things that is true about the current environment is that there's going to be a lot of pressure on issuers from rating agencies, and they, like us, have been reevaluating their stance on the revenue potential, the ability of these corporations to repay their debt. I will say that we are comfortable with all of the issuers in the district's portfolio. If that changes, we will certainly be in touch in very short order with staff about our change in stance. But we do not feel as though at the moment that there's any issuer to be particularly concerned about. And that analysis takes into account both who the issuer is and the term to maturity remaining on the securities in the portfolio. That being said, as I mentioned already, we do believe that rating agencies are going to continue their reevaluation. Like us, they're going to be paying attention to the earnings season. This is at the start of the crisis. Second quarter earnings have not come out yet. We expect those to be dismal, quite frankly, across the board. We have to see what the fall looks like. So we're continuously evaluating. Our credit committee was meeting multiple times per week in the midst of the crisis and continue to meet on a formal basis, more so than they had been in the past. With regard to the return, this quarter was a difficult quarter for anything that wasn't a treasury. You know, the stock market performed poorly. And as you went down the credit curve and up the risk curve, every additional asset class performed worse. So it wasn't surprising to see, you know, that corporations that were rated BBB, you know, were the worst performers. That trend has, as I mentioned, reversed itself somewhat during the second quarter, but we're less concerned about return potential at the moment and really focused on whether we're comfortable with their ability to repay the principal. So that's something, Director Rosario, I do want you to know that we're paying very, very close attention to. And if anything changes in our stance, we'll be immediately in touch with your staff.
Much appreciated. Thank you. And then my other question is, if we are in need of cash, don't we have funds in CAMP and LAIF
Yes,
that are easy accessible? Okay.
yes, you do.
Yeah, so basically selling off our securities would be a last resort.
Yeah, there's plenty of liquidity in the portfolio. And, you know, even though the, you know, securities portfolio is a last resort, you know, we always think it's important to have a liquidity profile there. I mean, you just never know what's going to happen. And, you know, in some instances, you know, there was that period last year where CAMP had more earnings potential. So we're just want to be flexible in the event you do need to raise cash.
Great. Thank you so much.
Thank you, Monique and Allison. Very straightforward report. And are there any other questions pending from Director Corbett or Rosario? Staff is looking for a motion to recommend to the full Board of Directors acceptance of the March 31, 2020 investment report.
So moved.
Director Corbett, seconded. Director Rosario,
I would second.
please take the roll.
Finance Committee Secretary taking roll call vote. Director Corbett,
Aye.
Director Rosario,
Aye.
Director Coffey.
Aye. So we're ready to move on to item 3. I tell you what, I think we'll get through this item and then take a 10-minute break, if that sounds okay.
Yes.
I want to keep us moving for the moment. So moving to item 3, that's the Park District's retirement plan update. Are you going to introduce this, Deborah Ocker, or do I go to Deborah Spalding?
Deborah Spalding, yeah. I'm going to do a brief introduction and then I'll turn it over to Mark Schulte, who's here from Van Ewert and Associates.
Thanks.
Van Ewert is, they are relatively new actuaries, so we began working with them last year, I believe. Mark Schulte is our consulting actuary. He's a co-owner of the firm and he's been with Van Ewert for over 10 years. And then one other piece I wanted to touch on before I turn it over to Mark, which was in the report in the packet, which is that we are working on doing an RFP for the Transamerica Plan Administration. So we have had Transamerica as our plan administrator since 1961, which is when the safety plan was first established, and then later the general employee plan. Over time, that relationship with Transamerica has declined. And so we've been considering finding a new plan administrator. We've been working with district council, human resources, and external advisors to draft an RFP. And we're hoping to get that out on the street later this year. And when we do, we will bring the results back to the Finance Committee. So at this point, I will stop sharing my screen and I'll turn it over to Mark.
Great, thanks everybody. I will share my screen. Bear with me for a second. I will get the presentation up. Okay, hopefully everybody can see that all right. So once again, glad to be here. My name is Mark Schulte, as Deb mentioned, the actual consultant to the district on the retirement plans. And today we're going to give a brief update on a few items. I'm going to quick flip to the next slide, the agenda. And we're going to do some actuarial background just because a lot of the things that we do are based on some pretty technical concepts. Just want to get some of these ideas in people's heads because we don't touch on it very often. We're going to talk about CalPERS pension plans, a little bit about the Transamerica pension plans, and then we'll have a break in there, a brief break for some questions on pension items, and then turn towards the OPEB plan. And just to reinforce that that is retiree healthcare. The acronym is Other Post-Employment Benefits. So to start off here, some brief actuarial background. The district sponsors various retirement plans, as I mentioned, and under CalPERS, you have both a miscellaneous and safety plan. And those have been for active employees hired roughly after 2000, 2001, depending on what group you're in. So they've been around for quite a while, almost 20 years. Then there's the legacy Transamerica plans. And those are really are only roughly 4 active employees left in the general employees plan. The rest are all retirees, and the sworn safety plan itself is all retirees or terminated vested employees who haven't commenced benefits. And then lastly, the retiree healthcare plan, the OPEB plan. And what we do on the actuarial side is we look at the value of these benefit promises that have been made to pay benefits that are off in the future. And we have to estimate what's the cost of those benefits in today's dollars, so the district can set aside money now to pay for those benefits when they become due. And part of that is calculating what's known as the actuarially determined contribution. CalPERS does that for the CalPERS plans, and then your actuary does that for the Transamerica and OPEB plans. And just to graphically illustrate what we do in a nutshell is based on all the data that we receive, and CalPERS does a similar thing for their plans, is we're able to project out when and to what extent retirees will receive a benefit. And so in this chart that we're showing on this page, this is for the OPEB plan, we're estimating that there's going to be roughly a little over $3 million in retiree payments this year. And those are projected to escalate rather significantly over the next few decades as more and more folks retire and start receiving benefits. And most pension and OPEB plans follow a pattern similar to this, kind of a bell-shaped curve. One exception is mature pension plans like the Transamerica plans, which we'll see later, where you're actually farther along on the curve currently, and it's almost a declining rate of payments. And so what we do is we project out these costs at each year in the future of how much we expect you to pay out. Then we discount all those benefits back to today's dollars based on your assumed investment return to calculate recommended contributions. Now, doing these projections of benefits is relatively straightforward on the pension side because there's a lot of good data about pensions and how people behave when they're going to retire. The benefits are relatively predictable since they're based on an employee's pay and their service with an agency. Retiree healthcare are notably more volatile than pensions, and we'll return to that concept later, but just want to mention that now that the projected payments for pensions are generally more stable than they necessarily would be in an OPEB plan where costs are more volatile. Moving along the next slide. So what are the purposes of these measurements that we do? As I mentioned before, calculating the recommended contributions, the funding levels, that's a primary focus of our calculations. We also prepare financial reporting results, and those are just a bit different. Sometimes the liabilities are similar to the funding numbers, but sometimes they can be a little different depending on if they have different assumptions. And then lately, the focus in the actuarial profession has really been on analyzing pension and OPEB risks. So not just what is your funded status today, what might it be tomorrow, but sort of what are the factors that can cause volatility in these costs long-term, because they are such a long-term liability, generally paid over many, many decades. And lastly, on this slide, I just want to talk about the measurements that we do. I might use some acronyms in our presentation. I'll try not to use too much jargon, but one of them is the actuarial accrued liability, the AAL. So it's the amount needed today to fund these future retiree payments if we meet all of our assumptions exactly. We never do. We just like to get really close to these models. The normal cost is the value of benefits as being earned for 1 year of service for active members. And then the unfunded liability is obviously just the accrued liability minus assets. So an example is in your CalPERS miscellaneous plan, as of the last measurement, there was a roughly $98 million unfunded liability, but that's based on a gross liability of about $350 million and assets of about $250 million. So we tend to focus on this net number, but realize that there can be some leverage since it's the difference between two results. And then one of the final concepts, I think I brought this up last year when I was with the committee, is this concept of the value of time and investment earnings on paying for the benefits in the future. And CalPERS uses this concept, I think is pretty useful, called the CalPERS buck. And essentially, for each dollar of those future payments that we saw in the prior graph, how much of that is paid for directly from employer and employee contributions versus just the investment earnings on those contributions. And here we see that roughly 58–60% of it they expect to be paid for with investment earnings. So that's really pre-funding these types of benefit obligations. You're able to leverage investment earnings to essentially offer higher benefits at a lower cost in today's dollars. If you just put contributions in a mattress and didn't invest them at all, it'd be much more expensive to provide the same level of benefits. So we'll first move on to the actual plans themselves here. And a brief update, just kind of summary, I should say, about all of the different plans is in one spot, the Transamerica plans, we had about a $5.5 million unfunded liability at the end of 2019, and about $1 million or so for the Sworn Safety Plan. And those are substantially lower than they were at the end of 2018. So that was good news. Given that, as we'll talk later, these plans have a risk profile in their investments that's supposed to be fairly defensive, that they actually had very good investment returns during 2019. The retiree healthcare had a roughly $10 million unfunded liability. However, I will mention that for some of the accounting measurements for these plans, they are often done a few months ahead of the fiscal year. So for the retiree healthcare, that plan, that $10 million is actually as of June 30th, 2019. That's when the CalPERS OPEB Trust Fund releases their audited assets. So we measure the assets and liabilities prior to year end for that plan. And then additionally, for the CalPERS pension plans, the unfunded liabilities there, about $100 million on the miscellaneous plan and $20 million on the safety plan. And we'll revisit each of these individually over the next few slides. One of the main topics that a lot of our clients are thinking about now is what is the effect of the recent market volatility on our pension plans? And CalPERS gets a lot of questions on this. They did host a webinar back on April 8th that other members of district staff attended as well, to kind of talk about some of the fears that folks have and to provide some confidence about how they're approaching the situation. Currently they were estimating at the end of April, or at the beginning of April, mid-April, that they were going to have about a 0% investment return for the fiscal year. So from July 1 to June 30, 2020. And that was their best estimate at the time, as we have seen the markets move quite a bit on a daily basis. But at least it's not very much in the negative range. We will see, though, that is below their estimate. They're targeting 7% returns. So they've effectively said that we're going to be 7% below our target this year. Another item to consider, too, is that the valuations that they're working on, and they actually have not released their June 30, 2019 valuations yet, but even the upcoming valuations, which will use the most recent asset valuations at June 30, 2020, those provide contributions for 2 fiscal years farther out. So we're not going to see this market volatility in your CalPERS contribution rates right away, but they will be seen eventually. They're amortized over a period. CalPERS has adopted a new way of spreading out those costs. It used to be over a 30-year period. effective with in 2019. Those are now spread out over a 20-year period, so a little bit shorter time period to recognize those costs. And they also mentioned they've developed this modeling tool. It's been available to employers for quite a while, but they have some enhancements, and also they said if an employer agency wants to do some modeling of their CalPERS pension costs, that they provided some rough parameters, especially the 0% investment return is kind of their best estimate of what should be used as a starting point for any pension modeling. So the next slide is a update on the historical funded status of the miscellaneous plan. I'm just going to focus on that one because it is the largest or the larger of the two CalPERS plans. And there's always two things I like to point out on these charts. And number one is the top red line, which is the accrued liability, generally has one direction and it's pretty consistent. It goes up. And that's because folks are continually earning new benefits each year. And that's at a faster pace than benefits are paid out. Also, there's the time value of money for these liabilities as we're moving forward in time. So the last measurement, the plan was roughly 72% funded. In comparison, the asset line, which is sort of the green shaded area with the dotted line on top of it, that's much more volatile. And that's something that in the pension actuarial realm, we have to deal with every day, which is we have a very consistently increasing liability, and we're comparing it to a much more volatile investment line. And the key is how can we manage investment volatility over the long term? These plans have a very long time horizon, but we do have to be cognizant that there are some short-term implications of investment volatility. If nothing else, there can be political implications. Folks can kind of pick and choose when they look at the asset values at any particular point in time. But we see that the funded status is not in a bad spot, 72%. That's on par with pretty much most other CalPERS agencies, since the contributions are all on a required basis. Moving along, we have historical investment returns. And how we like to present these are relative to the assumed investment return. So instead of just comparing to 0%, the dotted black line is CalPERS assumed investment return, so currently 7%. And what we want to see is the green bars, the actual investment returns above the black line. So there might be years like, say, 2016, where it was a positive return above 0, but that's still substantially below the assumed 7%. But over time, we want to see those bars up consistently at or above the black line. And we have to take this with a grain of salt a little bit as far as looking at historical periods, because coming into the end of 2019, a number of investment advisors, you'll see they'll have a mention of, oh, your return to date has been such and such over the past 10 years, 15 years, 20 years. It's really good, or it can be really bad depending on how you pick and choose the time period. And even just including the first quarter of this year really has a big swing on the actual investment experience. So generally, I don't like to focus on what's my cumulative return been over the past 20 years or 15 years, just because it can move so much over time. I will mention also that CalPERS has their investment de-risking policy. As they meet certain funded thresholds, they try to take excess investment earnings and move those into lowering the investment return assumption. There will probably be a period of time where they aren't doing any more lowering. They've said that they're going to stay at 7% in the near future. But I think that policy is constantly being reviewed just to make sure that they can balance the needs of the employers with contribution stability with that of the system, which is they need contributions to keep the system in a healthy place. And then one of the last slides we have on the CalPERS plans is just a chart that we've updated that shows the projected contribution requirements for the miscellaneous plan. And when we discussed this last year, we mentioned that the normal cost, so that's a percent of payroll that's charged to the employer and employee, that those costs are at a fairly stable level. They're increasing over time as payroll increases as well. But it's really this UAAL, the unfunded liability, that's a bit more volatile in the contribution area. And it has sort of this shark fin look to it. And that's caused by the way that CalPERS has the debt paid down over time for this unfunded liability. It's over different time periods. And so they're layered on top of each other. And this big drop around 2026 is from one of those layers of an old unfunded liability that was created in the past being fully paid off. And what we often see is that you just get additional layers building up over time, but this is the general pattern we see. It could be a little more volatile in the future with the different amortization policy that CalPERS put into place that's effective with the 2019 valuation, but it remains to be seen. It just takes a while for that to occur over time. But I think the main takeaway from this is substantially higher contributions need to be budgeted over the next couple decades. And there is the Pension Stability Fund that the district has set up to help not necessarily defer costs, but to sort of lower the volatility of cash needs in some of these high years. With that, I think I'm going to move on to Transamerica plans. I was going to take all the pension questions at the end of this section, but if anybody has a question in the meantime, please let me know. Okay. For the general employees and sworn safety plans, as I mentioned, these have been closed to new members for almost 20 years, and there's only 3 active remaining members in the general employees plan. They're very mature, and what this means is that combined, they're actually paying out more benefits than the contributions being received. That's not a bad thing. That's how pension plans are intended to work. You put money in up front, and then it pays out benefits over time towards the end of the plan. But that's really, we have to make sure that there's adequate assets in the plan trust to cover those benefit payments. So there still are ongoing contributions to these plans. They also have a phased investment de-risking approach that's been in place for a number of years, which gradually reduces the investment risk through the investment policy as certain thresholds are reached. So when you reach 90% funding, there's a certain trigger that can occur to reduce the investment volatility. And this is really a very progressive way to look at pension investments. And I think it's been working well for the district's pension plans. And really, it's nice to see a policy like this in place for plans like this. Here's our graph of expected benefit payments for the Transamerica plans. As I mentioned earlier, it's a lot different shape than for the OPEB plan because it is a more mature plan. And so we're already near the peak of benefit outflow payments. Those are expected to remain stable for a few years and then gradually decrease over several decades as the plan population matures. A similar chart for the investment returns, similar pattern to the CalPERS plans. The funds were down about 11% at the end of March, but as we heard from the investment advisors, in general, the markets have had a pretty good rebound since then. Still in negative territory, but not as bad as it had been as of the end of March. And these plans currently assume a roughly 4.8% investment return. So their investment policy is a bit more defensive than, say, a CalPERS plan, which is more ongoing and longer term that uses a 7% investment return. Then our funded status chart. And here, at the end of 2019, so this is January 1, 2020, the funded status of these plans had really improved significantly in the high 80s%, closing on a 90%. There's been a little bit of a setback with the market volatility. This was as of March 31, we did an estimated comparison, but that would have improved since then based on recent market fluctuations. So I would say the plans are in pretty good shape. We'd like to see the funded status improve, obviously, especially how mature they are, but given that they aren't really large contributions relative to some of the other plans, I think they're in a pretty stable position. And then lastly, we'll talk about the recommended contributions. These are calculated on a biennial basis. And so the last report we completed produced budgeted contributions for the 2020 and 2021 fiscal years, slightly lower than the prior fiscal years. These are based on January 1, 2019 results. So there's a bit of a lag between when the numbers are calculated and when they're applied to the fiscal year, but that's really for budgeting purposes. So about $2.5 million combined as an annual recommended contribution to these Transamerica plans. With that, I'll take a pause and ask if anybody has any questions on what I've talked about so far for the pension plans.
Directors, Corbett?
Yeah, I have some random questions. So we know that the costs of retirement go up over time for the various reasons you have explained. Does COVID-19 create any scenario where healthcare costs will go up even more than they have been? Are there any thoughts on that, how that impacts costs going forward?
Sure. I think it'll probably have more of an effect on the OPEB plan, if any. It's hard to know what that will be right now. We've seen news stories about how some of the COVID treatment costs have gone up, but a lot of the elective procedures have gone down. So there's kind of this balancing of different healthcare costs because folks are not seeking care for more elective procedures. How that will directly affect your retirement and OPEB plans, that's unclear. I think there's a lot of research being done, but we're still pretty early in the stages of the pandemic to understand that. One thing it could affect is that over the past decade or so, there's been a lot of updates to the expected mortality assumption that's used in both pension valuations and in the OPEB valuations about how long people are going to live and receive those pension benefits. It's unclear whether this pandemic will actually shorten up some of those expected timeframes for how long people are going to survive and receive a pension benefit, and whether it would even be meaningful. But it is something that I know the actuarial profession is starting to look at. There's just not enough data on it yet. We're too early in the pandemic at this point.
Wow, that's kind of morbidly interesting.
Yeah.
So you talked about the CalPERS de-risk strategies. Are they actually working?
They have been in place for several years now, and I think they've been doing as well as anybody. They have a very robust system in place for managing pension risk. And I'd say that they're one of the more advanced pension systems in the country as far as addressing pension risk. Most pension plans have had this old school view of we're investing for a return and not necessarily focusing on the volatility issue. And CalPERS has really been proactive in addressing those. I think ideally they'd love to have less volatility, but there's that balance. You still need to earn fairly substantial returns in order to keep costs manageable for most employers.
Mm-hmm.
So that they're really walking the fine line and doing a good job of it. I think they don't often get enough credit for it. What they're doing.
Yeah, it is nice to know that there is a strategy for sure. So with regard to unfunded liabilities and the chart you showed us where the larger increases are going to happen, the shark fin as you referred to it, will we be implementing any specific strategies in preparation for those years when it appears that the costs will spike before they go down again? Or the amount of unfunded liability increases, I should say.
Director Corbett, this is Deborah Alker. I can respond to that question. So the district has implemented several measures to try to smooth the costs over time. Setting up the pension trust was one of them. And so have been putting money into the pension trust so that we can smooth rates over that time period. And we also have been paying down these amortization layers that Mark spoke about in order to try to smooth rates. As he mentioned, In some ways, it doesn't reduce total cost unless we are eliminating long-term interest payments that we're looking to PERS. That's how we can actually reduce total cost, but it does allow for us to smooth rates over time. And then another thing that we're looking into, as the general manager mentioned in our previous item, is paying down long-term liabilities such as the closed retirement plans. So we have focused a little bit more recently on PERS rates because they've spiked and the volatility of trying to keep those rates smooth. But we really also can look at our long-term liabilities for the closed plans and try to get that funded status up a little bit closer to, 55%. And I think there would be great benefit in doing that for the district as well. So we're going to be looking into that with our investment advisor and our actuary to see if paying down some of those liabilities can be helpful.
So I understand the part of, smoothing the liabilities or the, responsibilities for those liabilities. But do we have any concern leading up to those very specific years where there seems to be that spike in liabilities that we're, targeting specifically towards those? Or is it just the overall, strategy, smoothing things in general over time? I'm just wondering whether we should be worrying about those particular years.
We do work with the PERS actuary along with Mark to look at ways that we can further smooth by looking at those amortization periods and paying down specific items. I'm not sure if that's answering your question, but we are working with them to try to maximize our savings and keep our rates as low as possible.
But it's going to add the our plan has, so we own about the shark fin.
Yes.
While, and so that is why one of the reasons we set up the pension trust.
Okay.
To be able to respond to that shark fin.
Okay, thank you, that's helpful. So when we eventually phase out the other retirement plan where we have a few people in it, how will that affect our overall picture? Will that be, will that make a huge difference to have just one retirement plan? I mean, what sort of impact do those last three or four individuals? I'm just wondering if we should be, those will be happy days because things get.
Well, once those plans, they don't really go away until the last beneficiary finished receiving benefits. So because we have 3 active employees, I think Mark's chart showed for it going on for another 20 to 30 years or even further before the plan is actually finished with its work. And when it is done, it will be administratively a happy dance for the staff. But, all the new retirees are in the CalPERS plan. So, we'll still have similar liabilities.
I was going to say it's a little bit like paying down your mortgage debt. So it would just be removing, we have costs every year that we have to pay for that Transamerica plan. So if we were able to chip away at that liability, over the long term, we would pay less for the plan. So we're kind of like paying off your mortgage. It saves you in the long run.
Okay. That's it for my questions. Thank you.
Director Rosario. Dee, do you have any questions?
There we go. No questions, pretty straightforward. I think I have more questions on the OPEB coming up.
All righty. Are there any, seeing no other questions, why don't you go ahead, Mark?
Okay, I'll move along here then onto the OPEB section. So can everyone still see the screen? Okay, great. All right, so the OPEB update, and this really relates to retiree healthcare benefits. Just want to reinforce that. We'll throw on the OPEB acronym a lot for other post-employment benefits. And this is really an area that's been getting a lot more focus the past several years. People are very familiar with pension costs, but over the past 3 years or so, OPEB liabilities have started to show up on balance sheets due to certain accounting changes. And so those liabilities, though they've been out there for many years, are becoming more prominent on agencies' balance sheets. And as I mentioned earlier, these costs are generally a lot more volatile. They're harder to predict because not only are we trying to anticipate employee behavior patterns when they're going to retire, how, at what ages, after how many years of service, but we also need to anticipate what level of benefit they're going to receive and how those benefits will grow in the future. So I like to compare a pension where you have the pretty consistently increasing salary and service over a career versus pension or versus OPEB, where we're trying to predict what healthcare premium costs are going to be 10, 20, 30, 40, 50 years down the road. It's just inherently a more volatile topic to deal with. So we have to kind of consider that. And a lot of employers sometimes treat OPEB the same as pension, and I will use the comparison a bit, but they are different, and I'll highlight that as we go along here. Another feature for OPEB is, unlike pensions, which started funding many, many years ago, generally OPEB is sort of new to the funding game. They were a promise that was made but not pre-funded till maybe the last 10, 20 years or so at the earliest. That being said, a lot of agencies have made progress, and the district has made great progress in pre-funding your OPEB liabilities. We'll touch on that in a few minutes. So we're back to this chart that I had at the beginning, and it's got two shades here, but it's the same numbers projecting out the cost, the retiree payment costs over the next several years. And this is about 80 years or so, 70, 80 years. And what we have here are, we've split it up into two different costs called the explicit subsidy and the implicit subsidy. And I don't want to get too technical on it, but these are terms that come up a lot when we discuss OPEB liabilities. And the explicit subsidy is really, what's the cost of subsidizing retirees' premium? Are you paying 100% of the premium cost, half of it, whatever it might be? Those are directly subsidizing retirees' healthcare coverage each year. The implicit subsidy cost is not something you really see directly. And where that comes from is when insurers come up with premium rates, they blend all the retirees and active employees together to come up with a blended premium rate that's paid for everybody. So when there's this implicit cost that's attributable to retirees because they have additional healthcare costs generally relative to the active employees. And under the accounting rules, we have to recognize those implicit costs. And we're going to touch on this a little later when we put out a liability number with regards to OPEB, to realize that that includes both the explicit cost, which you really are paying out each year, and then the implicit cost, which is a little bit more nebulous. It's a little bit harder to pin down, and you might not necessarily see it in your cash flow each year. Investment returns, I'm not going to spend much time on this chart because it's very similar to the ones we've seen, follows a similar pattern, and same concept too. There's an assumed rate of return, currently 6.5% for the OPEB trust based on the investment policy. Assets were down 10, 11% as of March 31st, but have rebounded since then. The trust is administered by CalPERS and their SERP program, and they really do a good job with administering the OPEB trust. It's widely used by agencies throughout California. The next chart is a comparison of assets and liabilities. And your liabilities actually had a much more stable pattern than many other agencies over the past few years. But we are seeing a little bit of volatility here. Part of that is attributable to just the change in actuaries. We were the new actuary starting in 2019 was the first year that we did a full valuation here. And as I mentioned earlier, there are many more assumptions that are used in these valuations, and there's a lot of professional judgment involved there, much more so than in a pension valuation. And so sometimes the liability measurement does vary a bit just based on who's doing the calculation of the costs. So that's part of it. You've also had some premium changes that haven't been as large as expected, so that helps the liability costs as well. Plus your green line, your funded your investment return has been pretty well. So The plan was actually almost 86% funded at the end of 2019, which is a great result. Moving on to the contributions, this is similar to the Transamerica plans where the contribution rates are calculated biennially. And there is a bit of smoothing that's done similar to the Transamerica plans where we spread out the investment volatility over about 5 years. And then the total unfunded liability, the unexpected changes are amortized or spread out over a closed period ending in 2031. So we're still in the process of developing the contributions for the 2021 plan year. The 2019 and 2020 contributions were already calculated and have been budgeted, are ready for the budget already. But 2021, we're still in the process of calculating those numbers. So, I would like to touch on a few topics here, and these apply to pension and OPEB. But really, retirement plan investments, whether they're pensions or OPEB, are facing a lot of uncertainty right now. And there's a lot of different opinions about how we may or may not have an immediate recovery, how long that's going to last. But what I've been telling folks is don't go into a pension panic or an OPEB panic on the investment side, just because these are such long-term obligations, and to really view them through that lens. Also, the OPEB liabilities are more volatile, and we want to consider that when you're allocating resources for contributions, we want to have the OPEB liabilities pre-funded to some extent, but just to bring up the concept that your pension contributions, say to CalPERS, those are mandatory. You must make those every year. OPEB contributions, there's more flexibility. You've implemented your own voluntary funding policy. So just to consider that as you look at the resources you have for these different benefit plan contributions. So questions on OPEB, there's in some sense more to talk about there, in some sense less as far as what's going on with those plans.
Okay, thank you, Mark. Director Corbett, questions? You're muted.
I do not have any additional questions. Thank you.
Thank you. And Director Rosario, you predicted having some questions.
Yeah, I do. I did and I do. So thank you. This is probably more of a question for Deborah, actually, but under retirees premiums, I'm just trying to stretch my memory here, but as far as medical, the only retirees that got full-time medical after they retired were managers that were hired previous to 2003. Is that correct?
I think there's a chart in your packet, which I don't have right in front of me. So OPEB, the retiree medical benefit, the district has changed its policy over time. And so there is, employees that were hired prior to a certain date have significant benefits. They get their entire premium paid for. And we still have lots of those retirees on our books, and they're getting, their family premium reimbursed. And so that was a very generous benefit. And then those hired after 2012 had a different benefit. And now today, I think that it changed in 2003 and again in 2012. So now employees that are hired, we have really, we're still providing a benefit for those that have met the years of service, but it's much more manageable and it won't incur as much health cost volatility because it's linked to a CalPERS minimum contribution, which is around $130, $140 per month right now. Yeah. So going forward, we will have less volatility as those that had the higher benefit do no longer receive benefits. Is that right, Mark? I think, when you see a lot of volatility in these types of plans, it's because they are linked to premiums that we have no control over.
That's definitely correct. You know, if you are paying a full premium, it could go up by a couple percent. It could go up by double-digit percentage. It's kind of like a pension that has a really volatile COLA, cost of living adjustment on it. You just don't know what that's going to be. Whereas, as you mentioned, the benefits for newer employees are related to what's called the PEMCA minimum. It's if you're enrolled on CalPERS health plans, it's a minimum benefit, roughly $140 a month, and it's just a bit more stable than basing it just on the premium.
Yeah. And then looking at your chart on historical investment returns, what happened in 2018?
That's, you know, and these I will say are on a June 30th basis. So as of mid-year, 2018 was a pretty poor year relative to other years. So that I think that's just the markets in that particular year.
Okay, great. Yeah, and I think that's it for my questions. And then just a comment as far as flexible payments. I encourage the Park District and continue to make payments into the recommended contributions, because that's how we got into CalPERS in the first place. We didn't. There was a period of time where the Park District chose not to pay into our Transamerica plan, and it caught up with us, and that's why we made the move to CalPERS. So, yeah, don't skip those payments. That's it. Thank you.
Well, and we haven't, and as a result, we have very healthy funding levels, funding percentages, especially if you keep your eye on what other agencies are facing and the leading cause of bankruptcies among public agencies.
That's right.
So this is continuing to be good news. This was information only. We would be moving on to item 5. It's a little after 2:30. I thought we might take about a 10-minute break. If,
Sure.
I'm okay with
Please.
that. Does everybody want to take a break? Because I'm fine with that.
I could use one.
Okay, then.
all right, so it's 2:35. So 2:45, we'll be back on. All right.
Yes,
Thank
some
you.
some of us have been in meetings since 11.
Well, some of us even earlier.
And thank you, Mark, very much for your very thorough review of our retirement plan.
Yes.
Thank you.
Thank you very much. Great report. Thank
Thank
you.
you.
Glad to help. Please let me know if anybody has follow-up questions. I'm glad to answer them.
Great. Thank you.
Thank you.
Okay, so we will have an official break. We will put everyone on mute and we will come back in 10 minutes. Deb, can you put up the Finance Committee slide?
Time to get started.
Yes, you're back, Ellen.
Oh,
I'm
yes.
back, and Dee is present. Deborah Walker, are we ready to go?
And Colin, I'm sorry, but I'm going to have to fall off close to 3 o'clock.
Alrighty.
Thank you.
Yeah, I'm sorry we've been going on, but I don't think we've been going too long, actually.
No, it's important stuff.
Yeah, it really is. So if we could move forward, do you want to introduce this one, Deborah Walker, fourth quarter 2019 general fund and other governmental fund financial reports?
Sure, I will introduce our Assistant Finance Officer, Michelle Strawson O'Hara. Make sure she's here with us.
Hi.
Our quarterly reports, and for the fourth quarter, we usually provide an information only because we're in the middle of finalizing our audit. So Michelle, take it away.
Hi, good afternoon, everyone. It seems my video is being controlled by the host right now, so I'm not able to turn it on at the moment. But yes, good afternoon, everyone. So next slide, Deb. Okay, so I'd like to start with an overview of the general fund revenue and expenditures for 2019, which can be found on page 96 of your packet. And the first column shows what we budgeted, and the second column shows the actual revenue and expenditures through December 31st, 2019. We'll drill down on these shortly, but you can see that the overall actual revenues exceeded budget by 8.3 million or 5.1%, and the actual expenditures were under budget by 14.2 million or 8.5%. Next slide. Okay, so if we look at the general fund revenue trends over the past 5 years, you can see that the main source of revenues, as we've discussed, is property taxes. And for 2019, actual revenues, they represented 88% of the revenues. And then for general fund expenditures, the next chart. So on the expenditures chart, you'll see that the salaries and benefits are the main component of the general fund expenditures, and they accounted for 63% of the actual expenditures for 2019. And next, I'll direct you to attachment B, which is on page 98 of your report, of your packet. And it shows the details of the general fund revenue and also the expenditures by category and division. Where there are variances against budget of over or under 10%, we've provided explanations at the bottom of the page. The most significant dollar variances in revenues are related to property tax revenues, which exceeded budget by just 3.4%, and investment earnings, which exceeded budget by 4.1 million due to higher than expected interest earnings and unrealized gains. Variances in expenditures related to unexpended salaries and benefits, which were 8% under budget, due to vacancies in several departments such as police and MAST. And the district, as you know, has a practice of budgeting 100% of authorized positions, regardless of whether they are filled. Supplies and services were also under budget, as the year-to-date actuals reflected in the chart do not include encumbrances for funds that have been committed or financially obligated at year-end. An example of a year-end encumbrance would be for the district fleet vehicles. There were new vehicles costing approximately $1 million that were ordered toward the end of 2019, and therefore we had a liability for them, but they were not delivered and put into service until early 2020. So now we'll look at the unaudited general fund balance. So you can see on the slide, we started the year with 64.1 million in unassigned general fund balance. Then when we add our 2019 revenues of 170 million and subtract out expenditures and other year-end closing adjustments of 162.9 million, we expect to have an estimated ending general fund balance of approximately 71.3 million. The district has a policy of reserving 32% of annual revenues to be used for emergency funding and other qualified circumstances. This year, the estimated reserve target is $54.8 million, providing a $16.5 million increase in general fund balance, which will be available to help smooth the impacts of the COVID-19 pandemic that will affect the Park District over the next several years. The general fund balance may also be considered for replenishing reserve funds, such as legal and election reserves, funding the major infrastructure renovation and replacement fund, and paying down long-term liabilities, such as pension obligations and other one-time costs. And as staff mentioned previously, staff will be proposing the use of available one-time funds along with the 2020 mid-year budget adjustments at the June Finance Committee meeting. On attachment C of your report, which is on page 99, this chart summarizes all the other funds. So special revenue funds, which include our lighting and landscaping districts and zones of benefits, and our project funds, which can vary significantly against budget due to timing of receipts. And we also have our debt service funds and our internal service funds, which pay for district-wide costs of workers' compensation, general liability insurance, major infrastructure and equipment, as well as employee benefit claims. So just to give you an update on our annual audit process, staff from Brown Armstrong CPAs, they have completed their field work, and they did this remotely this year. And we are expecting a clean or unmodified audit opinion. While we're still preparing our final closing entries for 2019, as well as our comprehensive annual financial report, we do expect these unaudited fourth quarter results presented today to be consistent with the 2019 CAFR. Given that the CAFR will be brought to you for approval at the June Finance Committee meeting, today's item is informational only. Does anyone have any questions?
Director Corbett, if before you drop off, you want to kick in with any questions?
I do not. I will be looking forward to the recommendation in June with the excess funds. Thank you.
Thank you, Ellen. Director Rosario?
I'm good, thank you. Very concise.
So we use the reference to the terminology of our fund balance and the way the state or other agencies refer to a surplus. Do I have that right?
Well, the more technical term is unassigned fund balance. That's what the GASB calls it, which is different than the reserves that we have that are obligations that are placed upon us or obligations and set-asides that the board policies have outlined.
Okay, but basically we're still referring to funds that the management had and didn't manage to spend.
Correct.
And therefore becomes available for any of the purposes Michelle reviewed, and 16.5 is a lot of money.
It is
and
much
it was
higher. Mm-hmm.
I guess than I've seen before. So you succeeded in controlling spending through the various means you described, but I would attribute a lot of it to just very good management and very good timing, given the likely deficit this year, to which that can be attributed and keep us balanced. So I don't have anything else on this topic. General Manager.
Yes, thank you very much. And thank you for the presentation. I think the board had a very robust discussion of what the potential needs are. There's a couple other things I want to bring to your attention. We have just a reminder, you already know this, but we have a significant liability at the Chabot Gun Club that we still are obligated legally to remediate. We've been putting some money into that every year, but it's a very big cost out there. So you can anticipate there'll be a discussion of that. Also, and this is clearly a decision of the board, but we do not get any Measure AA money in the Livermore area. So all of our land acquisition programs have been a combination. Doolin Canyon, et cetera, has a little bit of the Contra Costa County side in it. But like the HCP in Eastern Contra Costa County, matching funds are required to get money from the Altamont landfill, from other grant sources. So that's probably something we need to discuss. Clearly, for me, in my recommendations, a lower priority than protecting our staff benefits and retirement benefits, but it's something we should discuss. That would include the fact that we're just about out of any WW matching money for the HCP, while the HCP still has money coming in, even from the federal government. So those are just part of those deliberations. We want to make sure that we look at our future election costs. And there will be a few of the top almost completed capital projects, as Michelle mentioned, where we may have an ending balance that does not complete that project. We may have a shortfall. That would be a one-time liability. A good example, you just did that out of 553 for Contra Loma. And we're looking at the same situation on our only real swimming pool, Roberts, a historical part of the district, that also has a shortfall. So I just want to get that on your radar, that in addition to protecting the jobs, protecting our benefit liabilities, there are some one-time key components that would go into this. And we want to upfront acknowledge it was a very robust year. Last year, it's the highest I've seen. But that was because the economy was really ticking along, a lot of growth in both counties, the East Bay, a lot of values. So this would be one-time high priorities to deal with liabilities first, legal requirements, and completing some of the shortfalls that we might have on your priority capital projects.
A very good problem to have, actually. So are we, any public comments, Deborah Rocker?
I see that Director Corbett has a comment.
All righty, I'll go back to Ellen, but I'm assuming then no public comments. Ellen?
Yeah, just quick. Do we have a definition of what other qualified circumstance means, by the way, with regard to the fund balance, unassigned fund balance? I'm reading the definition here under the asterisk. So funding and provide emergency funding in the event of a disaster, temporary revenue shortfall, or other qualified circumstance. I'm just wondering if that definition resides somewhere.
No,
I mean, it's
no,
kind of
it
obvious. I'm
is.
just wondering what the actual definition is.
Yeah. Michelle, did you want to add anything?
Oh, I was just going to say, I could certainly pull up our policy that we revisited last year, but I believe it was to, cover just other sort of emergency circumstances was the idea, or, similar to the situation that we're in right now would qualify.
Okay, I would love to have the definition. You don't have to give it to me now, but
Yeah,
that'd be great. Thank you so much.
And just, we always like to remind that this is really one-time funding because it's not
Yes.
going. And so whatever we're setting money aside for should be one-time in nature.
Yes, and we do have some very worthwhile projects, as the general manager mentioned, some really important projects sitting out there in need of funding. Yeah. Thank you.
Okay, so we'll move on to item 6, accounting closure of completed projects. And this is an action item. Deborah Spalding. You're muted. There you go.
All right, thank you. This is an annual item, and so we come to you once projects are completed and to get official approval to return the funding that has not been spent back to its source. So just giving you a recap of the life cycle of a project at the Park District. So we establish a new project number when a budget is needed that's going to cross multiple years. So it can't be done in just one fiscal year, or if a capitalizable asset will result. projects can take many years to complete, and budgets for projects can be augmented many different times as the scope of the project evolves. We have a rule that we use our most restricted funds first. So if we have grant funds, we'll use those first, or bond funds, we'll use those first. And then when the project is completed, the process is to return to the board and request that the unused funds get returned to their source. So the report in the packet provides all the details. Here's just one example of a project closure where we have the Kennedy Grove Playground replacement project. At the completion of the project had $27,000 remaining. Because those funds came from the Major Infrastructure Renovation and Replacement Fund, the MER fund, we are requesting to return the excess funds back to that fund balance, and then they can be allocated to a future project. Just to summarize all the attachments that are in your packet, we, for our capital development projects, end up with unused funds of $610,000 from various funding sources. In the land acquisition, safety, and security projects, we have $275,000 that will be returned to their original fund sources. And in our other than asset projects, we have $702,000 that will be returned to their funding source. And there are summary tables in the packet that provide details. So the requested action is to direct staff to provide this project closure report to the board of directors for approval.
Director Rosario, do you have any questions?
No questions, and I move approval.
Second.
Director Corbett seconds. Please take roll.
Sorry.
Sorry.
Allie Haynes, Committee Secretary, taking roll call vote. Director Corbett,
Aye.
Director Rosario,
Aye.
Director Coffey,
Aye.
Thank you.
Are we ready to move on to the next item, authorization to renew the East Bay Park District's insurance program? Is Carol Victor? There's Carol.
Hi. Hi, directors. Nice to see all of you. I'm going to share my screen. And all right. This item is to renew the East Bay Regional Park District's insurance program. Normally during this presentation, we would do an overview of our claims, history, liabilities, and our workers' compensation program, and all of the other programs that are under risk. We've had a temporary vacancy in the risk department, and then we had the COVID emergency. So we're going to put off that more comprehensive review until later in the year. And we'll come back and do an overall snapshot of the district's claims history and workers' compensation program. So this report is exclusively on renewing insurance. Our insurance carrier is CSAC, Excess Insurance Authority. Through CSAC, we have general liability, property, excess workers' compensation, watercraft, aviation, crime, and cyber liability. The director should note that the crime, our crime policy was previously insured through Hub International. Because it was such a small insurance policy, we consolidated everything with CSAC this year. CSAC is the largest joint powers insurance pool in the country. It was formed in 1979. 95% of California counties are members of CSAC and 70% of California cities. It has 9 major coverage programs. The benefits of CSAC are its organizational strength and its stability and longevity. because of its size, it has significant buying power, and it has a number of other loss control services that they offer. Because monies is pooled in some of the, for example, earthquake insurance, some of the excess is pooled coverage. So we definitely get the benefit of the larger buying power. They've calculated that they've saved their members approximately $468 million over the last 5 years. While CSAC remains a very good joint powers agency, extremely well run, insurance rates are really continue to rise, and they're rising for circumstances really beyond the district's control. On the liability side, we have an excellent claims history. On the property side, we've had some property claims from the Corporation Yard fire, from the floods, the Star residence with the tree fall. So we have had some property claims, which accounts for some of the rise, but mostly it's reflective of the insurance market in general. The jury verdicts in California have gone through the roof, and just reflect that when somebody's injured and there's large medicals, that the cases can get very expensive. And there's just been an increase in $1 million jury verdicts or really large settlements throughout the insurance pool. So that reflects why our general liability rates are going out. Just a difficult market in California. And with regards to property, the CSAC's insurer was Lexington. They actually elected not to renew the property insurance. So there's a new insurer who CSAC has contracted with to provide property insurance. That change accounts for an increase, but it's hoped that these rates will be stable for 2 years. And with the property insurance, I think you can look countrywide and see what's happened with property liability in terms of major disasters and fires in California. On the brighter side, our workers' compensation insurance has decreased slightly by approximately 30,000. We are expecting, because our payroll numbers will likely be down this year, that we expect this rate to go down a little bit more when we get the final amounts. The total insurance policy that we're asking for renewal is $2.2,300,900. 100,000 of this is a self-insured assessment that we pay to the Department of Industrial Relations. With respect to this insurance renewal, one thing that we will be looking at next year is whether we should change our self-insured retentions. I'm sorry, I went the wrong direction. And our general liability self-insured retention is 500,000, and we erode that self-insured retention very infrequently. So we will be looking at whether we should lower that self-insured retention and how much that would increase our premiums. Similarly with workers' comp, our self-insured retention is 300,000, and we rarely erode that as well. So those are two things that we'll look at next year. I believe the whole insurance program needs to be looked at in terms of work with a broker and compare other policies, but I don't think this is a great market to do that in. So we'll focus on the self-insured retentions for this next year, and then within the next 2 to 3 years, look at the overall insurance program to see if we could do better than we're doing with CSAC. So with that, our recommendation is to renew the insurance program of in the amount not to exceed $2,203,900, and as part of that, $100,000 would go to the Department of Industrial Relations to pay the workers' comp self-insured assessment. Are there any questions?
Thank you, Carol. Director Corbett?
I would just say it sounds like a great recommendation. I think it will be important for us to take a look and see what's out there in the future, whether there's any other better opportunities. And then I do have a quick question for cyber liability. I see that that has doubled pretty much. What does that cover? If we are hacked or?
Yes, if I may, our acting risk manager, Constance Bassett, is on the phone, and as is, or is on the Zoom call, excuse me, as is Janet Land. And I would like to turn it over to Constance to answer the cyber liability question.
Thank you.
Hi. Yes, it does cover if we are hacked, and if whatever information was, for lack of a better word, stolen or taken, then there's a whole process in place that instantly is enacted so that if, for example, the public was involved or our employees. And so the coverage would include things like notifications, if their credit was disturbed in any way, there's also a free credit report. And it also covers if our employees were to do something that created some type of breach. And the reason why cyber insurance is becoming more and more relevant, and all of us have experienced breaches in different areas of our life, and that's why it's gone up in price, basically. Does that answer your question?
Directors,
Yes, it does. Thank you.
Okay.
And if I may introduce Constance to the committee, she came to us from County of Alameda. She's a retiree from the County of Alameda, and has since February has been filling a temporary vacancy, and we've really benefited from her broad view and broad experience in workers' comp and risk management.
Good to have you. Thank you.
Yeah, welcome. Thank you.
Thank you.
Ellen, any other question?
That's it. Thank you.
Director Rosario? Nothing? I have a couple, Carol.
Sure.
We have D&O coverage in here somewhere?
E&O or directors? Yes. I believe that, yes, we do.
Just, it's a little close to my heart. And that would be with the general liability carrier?
Yes.
All right.
It's it may be part of the bonds, and it may be part of the bond coverage as well, because sometimes elected officials are required to post bonds, but I would have to defer to Constance if you can answer that. Constance, if you cannot, we'll follow up and answer the board members' questions.
Excuse me. Yes, as far as I know, Carol's answer was correct. And we can validate that and make sure, but yes, it's under our general liability. And like Carol said, there may be some bonding requirements also.
Okay, that's good to know. And lastly, EPL coverage. Do we buy EPL coverage? Employment practices liability coverage?
We do have employment coverage through CSAC.
Those were my two questions. Does the general manager want to make a comment? No?
No, I think this is another situation where we're going to have to look hard at the future costs and liabilities. Obviously, these costs are going up. Also, I know that just in our IS department, we're getting hundreds of attempts, if not more, to breach our firewalls. So it's another area that we have to continually invest in to protect the finances of the district and protect our our confidential
Yeah, data.
discussions and data. It's just another one of these things we have to look closely at.
Thank you. And whose turn is it to make the motion? I think it's Ellen's.
So moved.
Thank you.
Director Rosario.
I will second.
So please call the roll.
Allie Haynes, Committee Secretary, taking roll call vote. Director Corbett,
Aye.
Director Rosario,
Aye.
Director Coffey,
Aye. Thank you, Ally. So next,
Thank you very much.
next
Mr.
item.
Mr. Chair, I'm going to sign off, but thank you
All
very
right.
much. I will see you all later.
Thank you, Ally.
Aye.
And thank you, Carol. Next is general public comment. Deborah Walker, any requests for general public comment come in?
No, as we mentioned at the beginning of the meeting, we had noticed the meeting and stated that people could make comment by email, by voicemail, or they could join the Zoom meeting. And we requested that they contact the committee recording secretary if they would like to make a public comment. I don't believe we have received anyone stating that they'd like to make a public comment, but we have a few members of the public on the call if anyone would like to speak. Looks like we are in good shape.
Okay, seeing no public comments coming forward, we move to committee member comments. That's down to you and me, Dee. And any comment?
Just another good reports from Finance Department. Deborah, you should be congratulated on the reports of your staff. It's good to see that we're in better shape than you and I had expected. Even though we're having a little bit of a shortfall, we still have a very robust mid-year and then from our and then replenishing our MER of almost 0.7, well, 700,000 back into the MER. So I think we're in good shape, and I'm proud to be part of this organization that is fiscally responsible, and that we have the means to take care of our people. So thank you very much.
Yeah, I agree. I feel pride in that. And, normally I would be jumping up and down, cheering our success, the financial success, the financial position that we're in. And it's just really hard to do that given the bleak background in which we're existing today. But this is replete with indications of very good management, very good planning. And if there's a time at which you want to be doing well, it's now. Not only because of the bleak background we're working in, but because it's, as the general manager noted, we're in huge demand right now. And we're going to need all these resources that we've succeeded in putting together. So before signing off, I see a couple of hands. Dr. Alvarez.
Thank you, Director Coffey. I just wanted to echo and thanks and express my gratitude to the board, because the Park District is indeed well poised to be able to address and mitigate the economic recession that we're heading into. And kudos to Deborah and her team. They've done a beautiful job in being able to provide guidance and leadership as we make difficult decisions at the smaller level all the way to the big decisions that really contribute to the position in which we find ourselves today. So it's a good problem to have overall.
General Manager.
I agree with all those comments. I do think, not to be the bummer in the crowd, but I feel like we're at the inland coast and the bay, and there's storm clouds off the coast coming in. And we're going to batten down the hatches and do the best we can, but there are certainly storm clouds out there on the horizon. I wanted to take a moment just to express my appreciation to all the staff. Obviously, we haven't talked about Memorial Day weekend yet. Every single park was full. And even with massive crowds, and I do mean massive crowds, people in the East Bay, for the most part, there's some bad actors, but for the most part, people are really adhering to our messaging. We're now in the second phase of public service announcements about wearing masks and about social distancing. And overall, we did well considering how crowded we were. But I just really want to express my appreciation to the field staff, to public safety, to the park supervisors, to the managers for getting us through yet another huge surge of people over the weekend. Without most of the incidents were actually, and we'll share there with the board Friday, were almost humorous. We actually had a cow who stole a sign. If you probably saw that on your we had, as of this morning, we had somebody in a four-wheel drive stuck in Alameda Beach. So those are kind of, as Dee knows, those are kind of your big weekend normal incidents that happen in parks. But the overwhelming amount of people in the parks handled by our staff. And I want the board to notice on the updates from the field on the weekdays and the weekends that you're starting to see actual comments from staff who are presenting pictures of getting other things done. And I think that's just remarkable. And I'm so proud of the staff and so appreciative. And I just wanted to express that to you two right now, because I know you care deeply about what's going on and you're out there in the parks. And it was kind of like, yes, we survived another tsunami, but we did it well. And I'm very proud of what we're contributing to the public and doing it as safely for the staff and the public as we can. And there's always, and finally, I just want to say, and it may be not taken well by some, but we're not getting a cheerleader to say, please help us. We're getting actual people acting out in some areas because they're being encouraged to act out against masks. And I really think that's sad. It's unfortunate and irresponsible. And so we had a couple of protests over the weekend that didn't amount to anything, but just people are being encouraged to rebel against the shelter in place. And it's not just normal, sick and tired of being locked up. It's some encouragement. And I really think that's a sad state of affairs. And I just feel like I need to say that because it's affecting our staff. You know, when somebody doesn't want to listen to direction or wants to do something to a sign, we had some vandalism on signs. It's not helpful. It's just not helpful. And we should be trying to help each other. So I feel very strongly about that. Thank you.
Thank you. We agree, it's disappointing. Dee, do you want to have the last word? I saw your hand. No?
I'm good.
Okay, we're all good. Thank you very much. We'll adjourn the meeting.
Great. Well done, everyone.
Thank you. Thank you.